Hi there, I'm verified Algo trading champion Kevin Davey, and today I'm going to look into martingale position sizing. And really, what I'm going to talk about is the and beyond part of it. So let's get started. So today I'm going to talk to you about anti-martingale strategy. And hopefully you know what a martingale strategy is. Well, the anti-martingale is the exact opposite. Both of them, you start out by betting one unit. Okay? One contract, one share, whatever it is. And with an anti-martingale, if you win, then you double your next bet. And as you can imagine with the martingale, if you lose, you double the next bet. And the third point is when you finally lose with the anti-martingale, you go back to one unit. So let's take a look at a sequence here. So you go from top to bottom, top, bottom. So you bet one, let's say you win. Well, now you bet two, then you win. Then you bet four, and now you lose. Then you go back to one. And you win, you go up to two, you win, you go up to four. If you lose, you go back to one. So it always ends with a big loser, but you always win with the ones. Well, you don't always win with them, but when you win, you double. So you keep doubling as long as you're on that hot streak. So a lot of people like this because, hey, the dice are hot, that would be a Vegas term. But wow, my system is tuned in and it's just getting win after win, so I should increase my size. Well, that works great until you lose. Okay. There's a comparison with the martingale, a modified martingale, which I talk about in another video, and the anti-martingale. In this particular sequence of trades, anti-martingale is actually worse than the martingale and modified. But if you just flip those trades, now anti-martingale turns out to be the best. So again, it's dependent on how those wins and losses come in, and you change them up and you're going to get different results. So that's important to think about if you apply this to any kind of back test, because if your back test distribution of wins and losses and when they occur, if it's any different than real time, your position sizing is going to be affected by that and your end results too. So here's an example from July of 2024 with the Australian dollar, Japanese yen. So what I have here is different factors. So a factor of 2 is a standard anti-martingale. And then as you go lower, it's kind of a modified anti-martingale. It's not quite where you double. You do something less. So this one would go 1 to 2 to 4 contracts. But this one would go 1 to 1.75 to 1.75 times 1.75. That would be your third one. So it increases more slowly. And you can see you have these downward trends punctuated by a big gain, and then of course you always lose that last one, so then it drops down, starts over, get the big gains again. So when you get that winning streak is when you get that near vertical line, and that's what you want. But eventually you run into a losing streak, and that's what happens here and here. And then as you lower your factor, you get closer and closer to what would be a just standard one contract all the time result. Okay, so you kind of get a sense of what the anti-martingale does. It prevents you from disaster, at least in this case, because if you recall, if you've seen my martingale video, this particular example, the martingale just got blown out. So that doesn't happen here, but you do get quite a bit of drawdown. So looking at this approach, you could say, well, anti-martingale could be pretty good because the martingale one did not work, and maybe martingale is not the answer, but maybe anti-martingale is. So I decided to look at a portfolio of 5 strategies just to see what would happen with Anti-Martingale. And I also added a twist where I didn't keep doubling or adding to it, because you can't really do that too much. You can go 1 to 2, 2 to 4, 4 to 8, 8 to 16. That starts getting scary. 16 to 32. So I decided to cut it at 8. And again, with that Japanese yen example, the anti-martingale looks the best. But with a portfolio of 5 different strategies that I disclose to my students, they come with my course. What works best? Well, here's what it looks like fixed size. Not too bad. It's pretty decent. So that's always trading these number of contracts. But if you look at the anti-martingale, you can see it's a lot choppier. Drawdowns are a lot bigger and a lot nastier. So I'll flip back real quick. There's what it looks like with fixed size. There's what it looks like with the anti-martingale. And I even reduced the anti-martingale with this factor, and even that doesn't look that great. I mean, there's a big long drawdown in there with the anti-martingale that you didn't really see with fixed size. Okay. So the conclusion, hey, anti was better with that first example, but it wasn't so good with my portfolio. And the baseline in both cases looked pretty decent. So what I'm trying to say here is anti-martingale is not the answer. It is not the answer to your position sizing needs. Martingale is not the answer to your position sizing needs. It really depends on the strategy. And maybe it's worked the past 10 years with a certain way. Doesn't mean it's going to keep working, because trading systems have a way of changing over time. The distribution of wins and losses changes as you go to real time. So be careful with any position sizing. Hope you liked this video. If you did, leave a comment, give me a thumbs up. I'm Champion Trader Kevin Davey. Have a great day.